Okay, good morning and happy Tuesday, everyone. My name is Tony Zhang. I'm the Chief Strategist here at Options Play, and we're here to talk about the markets here again. So I have a lot to cover with you here today. Sorry about the couple of minutes late start, but let's go ahead and get started. Let's skip over some of the housekeeping items other than the disclaimer saying that what we're going to discuss here today is purely for demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. Now, the question that I want to help investors answer here this morning is really, are we at a market top? Are we seeing the formation of a market top at the current moment? There's a lot of questions around, have markets topped at this point because of the lack of momentum? We've seen earnings not push many names higher. We've actually seen quite a few significant drops, and we have a pretty major week this week with respect to earnings. So the question is this what's going to bring the markets lower? And there's a lot of things at play here. So let's go ahead and take a look. My name is Tony Zhang. I'm the Chief Strategist here at Options Play. Let's go ahead and take a look at some of the charts. So if we take a look at the S&P, first of all, last week we talked about how we managed to just break out above this major 323 level that we've been talking about for quite some time. But as you can see, that level has failed. And we did warn investors that on that recent push higher, what you have was a higher high in price, but momentum did not confirm that move higher. And that bit of negative divergence is what pulled the markets back here. So markets so far have resolved that negative divergence, and the question is whether markets can continue to move higher. Now, our base case is still that the markets have more of a bullish tone to it rather than bearish, but there is some likelihood that we might get a bit of a sideways price action here over the next few days, next few trading weeks, potentially, as markets kind of digest all the information from an economic perspective, from a fundamental perspective, and also from a fiscal policy perspective in terms of July 31st is when federal unemployment runs out, and the Democrats and the Republicans at this point are still pretty far apart as far as what they want the fiscal and unemployment benefits to look like going forward. Republicans are at $200 a week. Democrats are at $600 a week. That's a pretty big gap, and they only have a few days before those unemployment benefits run out. So we are watching to see how that plays out, because that will likely reflect very heavily on consumer confidence, consumer discretionary sectors, which is one of the strongest sectors here in the market. If we look at technology, the Qs, we've been warning about this movement here in Qs for quite some time, because you have this massive divergence here on the weekly chart. And also we've mentioned here over the past few weeks that every single time the market pushes higher here, this is the NASDAQ 100 index, it was not confirmed by momentum on those moves higher. So we're starting to see the markets fail and become a bit more exhausted and start pulling back. The question is, how far can markets pull back? Is it going to pull back a little further before it continues to move higher? We've certainly seen technology start to lag behind here as far as the sectors. So we are going to take a look at all the sectors and review the sectors today. So please, we're going to take a look at that. Emerging markets is one of the few places that are starting to see some leadership. We've talked about this for the past few weeks, but after breaking out above that $42 level, EEM is starting to continue its way higher. It is leading the market. You have this double top here at 44, breakouts here above 44, bringing you back up to that 46 and a half level here to the upside. You have both daily and weekly momentum being positive, and for the most part, momentum are confirming these moves higher. So emerging markets, one of the places to keep an eye out for. Small caps, still leading the markets a little bit, not by much. Small caps does have this major, small caps does have this major resistance level here around 47, 48 or so, the 200-week moving average. It's managed to get back above the 200-day moving average. So you have some rising support here from both the 20-day and 200-day moving average. So I do expect small caps to rally and continue to move higher here, especially if equity markets like the S&P and NASDAQ can at least stay flat. We might see small caps start to rally here and lead the markets higher here. So this is the healthy part about what we're currently seeing. We have a healthy amount of rotation from growth into small caps, into value. We also see this in equal weight. So what we're seeing is that it's the mega cap names that are actually seeing some worse performance over the past few trading days and past week or so. And that has led to the equal weight index actually outperforming because they don't, the massive names are not hurting the equal weight indices as much as they are the market cap names. So RSP, the S&P equal weight index, leading this market higher here, potentially retesting that 112, 113 high here on equal weight. So these are the healthy parts of the market. The fact that we're still seeing rotation here in the markets. We're seeing that the very high performing sectors like technology and communications pulling back and rotating into some of the other sectors. That is what's healthy here for us. There are a few things that are concerning. Silver seems to have gone a little too far too fast. It's pulled back here today to the $22 level here, but this is I think the best performing four-day performance on silver on record ever. So this is, in my opinion, a little too far too fast. It has to correct lower here. Along with gold. Gold, we've been talking about this as gold managed to get back to that 1900 all-time high that it put in September 2011. It managed to break above that, but it's consolidating a bit as we would expect after it hits a all-time high. The question is whether or not after the consolidation phase, we're going to see a continuation higher. So likely we might see a bit of a consolidation phase and then start to continue moving higher, because the primary reason we're seeing this move here in gold is really because of the dollar. So we've talked about this breakdown here below $96 in the US dollar index. And one of the things was that as dollar index started to move lower, there was negative divergence here on the daily chart, but that has now resolved itself. You now have a lower low in price and a lower low in momentum. So momentum is now confirming this move lower. So what you might get is a bit of a pop here back to 95 and then a continuation lower here. So if you're trading currencies, if you're trading gold or silver, look for that consolidation period, then start looking for potentially longs in this particular name, whether you're trading currencies or gold and silver. VIX is still continuing to tick lower here, not quite as low as we would expect after making relative all-time highs here. Still trading around this 25 level, but VIX still very firmly in contango. You have the front month VIX as 25.5. 3-month VIX is 30. So the ratio of that is approaching 1.2 VIX 3 months to VIX. That, generally speaking, is still considered a bullish indicator, meaning we're nowhere near a stress market. So for those asking, are we near a market top? Are markets going to reverse lower? It's not to say markets can't reverse lower. It's just to say that the markets in its current state is actually fairly healthy, and markets are seeing a fair amount of, but there is a bit of complacency. If you look at the put-call ratio, what I have here is a 20-day average of the put-call ratio. Put-call ratio continues to make new lows here, and this usually corresponds with complacency, as you have more people trading calls versus puts, and that ratio continues to skew to the call side when you don't have people buying puts. What that generally means is that there's a lot of complacency. We're actually even seeing more complacency than we did in January of right before the sell-off, or January and February. So markets are actually more complacent than they are back in January and February. That is a concern to us. So even though right now our base case is still that the markets can continue to move higher, our views here for the moment is that because of the complacency, that it is likely that we might see a bit of a consolidation over the next few months, especially as there's a lot of uncertainty around fiscal policy at the moment. There's a lot of uncertainty around the election. That's going to add to some uncertainty here, and we do have a big week on earnings here, so it's important to see how the tech names respond to earnings and see how the market responds to those earnings reports, because that is heavily going to dictate where markets move going forward. Now, I did want to point out some seasonality, because we do get a lot of questions around seasonality, and we are approaching one particular 3-month section that is particularly interesting, and that's from August to October. These are all 3-month returns of the S&P 500 starting from 1928 to present. And August to October is the only 3-month period on since 1928 to now where we generally speaking have flat returns, and that happens about 55% of the time where you have a flat return. So what we're basically showing here is that despite the fact that we have a fairly bullish view going into at the current moment with everything, with the health of the market rally, the amount of complacency we're seeing, the amount of uncertainty we're seeing currently in the markets lead us to believe that over the next few months, we're likely to get more chop, maybe some consolidation as markets move a little higher, move back a little lower, move a little bit higher, move a little bit lower. That type of price action is what we are likely going to see. One big grain of salt about seasonality is that seasonality is a big average of a lot of different time periods, and over those time periods there are some pretty extreme cases. So I'm sure if you look at 1929 to present, there are plenty of cases where perhaps a single year where it's still pretty high and a single year is still pretty low. The averages out to being flat, but so this take seasonality with a grain of salt. Another seasonality analysis based on just August alone. August is generally a positive month, about 0.6%. So not too high, not too low. Versus September is on record one of the worst months for S&P performance. So, you know, what you might see is that you might still get a little bit of gain here in August, and then a sell-off here in September, and the two balance each other out going into the election year. So seasonality, interesting to look at, but make sure you take with a big grain of salt because it is just an average. I did want to point us to economics because we've seen a lot of economic surprise to the upside, and I think this is part of what has been driving the markets higher. You know, you couple with the fact that you have a fairly strong fiscal and monetary policy, you have a vaccine optimism in terms of all of these pharmaceutical and biotech companies pursuing vaccines, many of them showing some positive results in late-stage trials, now going into massive human trials, late-stage trials to go into production by the end of this year or early next year. You have contracts that are already signed so that once one of these companies passes their clinical trials, they can start shipping hundreds of millions of vaccines. So there's a lot of optimism here in the market, and you couple that with the economic surprise that we've seen, and I don't think it's too surprising where markets are currently trading. And I think I know a lot of investors are saying the fundamentals don't match up with where we are. You know, at the end of the day, the markets trade where they are, and it's important that we look at where they're going to trade rather than where they necessarily should trade, because markets aren't necessarily always just discounting the current information, they're also discounting future information. So if we look at economic surprise, durable goods came out actually stronger than expected. The survey was 3.6%, but the actual was 3.3%, not as high, but still a very positive number here, one of the highest numbers we've seen, as you can see. So the fact that we're still seeing durable goods being relatively strong, most of it coming from transportation, but as you can see across the whole board, all of them are positive. This is part of why the markets reacted fairly positively to the durable goods economic numbers. ISM readings also relatively strong. The Dallas Manufacturing Fed survey was -4.8. The actual was -3. So very strong rebound in terms of manufacturing here from the Dallas Fed's survey in Texas. And if we look at the regional manufacturing surveys, it is currently pointing to what could be a pretty strong number here for the national ISM reading. So the economic surprise across the board in terms of economic activity from a manufacturing and durable goods perspective, relatively strong, in line with most of the other economic indicators that we're currently looking at. One of the weaker ones is really unemployment. That's the one that we continue to keep a close eye on. But you know, those are some of the economics. And I did want to walk everyone through the sectors here because we've seen a fair amount of sector rotation. This is continuing to shift, which is good. Again, sector rotation is strong and healthy for a market. If you just see one sector continue to dominate over and over again, that's what we consider an unhealthy rally. But we continue to see this rotation, and that is, generally speaking, a strong suit for a healthy market rally. So at the top of the sectors is consumer discretionary. Consumer discretionary, consumer confidence remaining strong despite the fact that you have $600 a week in federal unemployment falling off in just a few days here, and the Republicans and Democrats have not agreed on a strategy or a plan just yet for going forward. This is one that is at risk, but this is one at the moment that's still remaining high. And arguably, one of the reasons why markets are trading where they are is because consumer confidence remains strong. So you have a breakout here in consumer discretionary that has some negative divergence. So you have the same issues that we see in technology, where it made a higher high, but did not make a higher high in momentum. And I think this poses additional risk for consumer discretionary to pull back here. When you have Amazon and Home Depot, Amazon probably be the main driver of this, is probably the one stock that can potentially bring this sector lower before it can continue moving higher and resolve some of that negative divergence. Materials, also one of the leading sectors. Materials surprisingly strong, but same thing, higher high, but you still have momentum, not really confirming these moves higher here. But both the daily and weekly money flow relatively strong. So I am positive here on this sector that you could get a small pullback, resolve that negative divergence, and continue to move higher here. Technology has really started to lag behind here. So as you can see, over the past month and a half, as it continues to make higher highs, momentum is actually moving lower here. And you see the same thing that we saw on the Qs, the NASDAQ 100 index. As it continues to move higher, momentum did not confirm that. Weekly money flow barely positive. Daily money flow looking a little stronger here. So technology might see a bit of a further pullback here before it can continue to move higher. But again, that's good, because you can't have a sector that just moves higher and never moves lower. It has to resolve some of that. It has to consolidate before it can continue to move higher. So despite the fact that we can see that as a concern, we see this as a healthy market rally for that to happen. Healthcare lagging behind quite a bit here over the past few months here, barely really moving much higher, but it has managed to make its way back above this 105 resistance level, 105, 104 and a half or so, breaking it higher, coming to retest this as support and potentially moving higher. So we might see healthcare, which has actually been lagging behind for the past couple of months, maybe start to take a little bit of leadership. And healthcare actually confirming these highs, both on the daily and weekly chart, and money flow remaining positive on both the daily and weekly chart. So I think healthcare is certainly one place to start paying attention to, specifically the pharma and biotech space, which is why we were looking at IBB here as a trade setup here. Consumer staples also starting, lagging behind over the past few months, but starting to come back to life. And as you can see, as it makes a higher high, momentum is confirming those higher highs. We're seeing that across the board. Money flow remains barely positive on both the weekly and daily chart, but that's good for a continuation up into about the 65 area here for XLP. If we look at industrials also taking a bit of a decent move here. Industrials really coming to life ever since silver started to rally. Those two very heavily coupled. XLI contending with the 200-week moving average here around 72, and also the 200-day moving average. So you have some massive resistance on the daily and the weekly chart. And if it can continue to break out higher here, industrials will likely to see a continuation higher here, but it has to break back above those resistance levels, which it hasn't quite yet, but that is certainly one that we're paying attention to here. Utilities really underperforming here. As markets continue to move higher, utilities are at first rebounded faster than most other sectors, and then it's just been trading sideways. And because it's trading sideways while the markets are actually continuing higher, what it's really doing is underperforming the markets, and that's never good for a sector like this. For those of you that are looking at this chart, you might notice this looks like a bit of a head and shoulders and is likely going to revisit maybe that $56, $54 level here to the downside. If there's any corrections lower here in the market, utilities likely to underperform here. Both the weekly and daily chart looking relatively weak. You actually have negative money flow on the weekly chart, money flow on the daily chart looking barely positive, not particularly strong here for utilities. Same thing for real estate. Real estate really lagging behind here over the past few weeks as markets continue to try to push higher. Real estate pushing sideways here. So you have real estate, and I don't think it's surprising for many users to see why real estate is moving lower here. So real estate, certainly not one of the sectors that look very strong. Financials, starting to come back to life a little bit, but can't quite catch that momentum. Most of it, from my perspective, is due to the fact that interest rates cannot lift off, that you still continue to see interest rates get compressed lower and lower. This is going to continue to put a cap here on XLF, in my opinion, but it is still currently remaining above a key $23 support level here. But if it breaks below $23, that's when I think that you're going to likely seek further weakness here for XLF. But right now, 23.5 holding. Potentially it can start moving higher here, but we're going to keep an eye out here. Financials, the second weakest sector, but maybe starting to turn around a little. XLE, still one of the worst, still the worst performing sector. As you can see, money flow still remains fairly weak here on the daily chart. On the weekly chart, just remaining positive, but momentum indicators not really turning positive here. Can't really seem to find the legs to continue moving higher here. But oil also not lifting off, but oil is, I would say, finding support here and trying to lift off here. But despite the fact that you have a weaker dollar, oil not moving higher is not a particularly strong indicator for oil. So I think that your risk is more to the downside here in energy names. So if you're looking at some of those energy names, I think the risk to reward skews more to the downside rather than to the upside. So that's a quick review of all the sectors and where they currently stand and how we're currently looking at it. Like I said, we have a earnings calendar that is dominated by big tech here this week. Pay attention to here. You have a bunch of semiconductor stocks. You have Apple, you have Amazon, Facebook. So big names that are likely going to affect XLE, that's going to affect the NASDAQ 100 index. Perhaps we see these names continue to show a little bit of weakness, let technology bleed off some of that momentum and negative divergence. And again, that is healthy for the markets to experience that and rotate that into some of the weaker sectors like communications, like industrials, materials. If we see that type of rotation, that is generally speaking strong for the markets. But healthcare is the one that I'm keeping an eye out on. Industrials, I'm keeping an eye out on for potential breakouts here to the upside. So just a couple of names before we wrap up here today. Home builders. So for those of you that caught options action on Friday, Carter laid out a thesis for Sherwin-Williams, which falls under the materials and home builders section. So home builders, relatively strong. D.R. Horton breaking above the 62.5 level, broke out above it, came back to retest this as support, and is now starting to continue moving higher. So you've got that breakout, retest this as support, and is looking to continue moving higher here. So strong weekly money flow, same thing, daily money flow. There is a bit of negative divergence here to the upside here. So that is something that is concerning. And this is something that we continue to see across the board for most sectors and most names, is that negative divergence. So be careful, be cautious. My preference here is to use call options to take this type of bullish view, because with you have that negative divergence, you always have a higher risk of a pullback, and you want to make sure that you risk the least amount of capital possible. And the best way to do that is using calls and call spreads. That allows you to play for further upside, but if you do get that pullback, you're risking only 3, 5, maybe 6% of the underlying stock price. No matter what happens, that's the most that you risk. And lastly, FedEx. I wanted to look at FedEx because we've really seen a bit of a turnaround here in FedEx. So you have this downtrend that recently was broken up to the upside. You have confirmation on both the weekly and daily chart in terms of momentum continue to move higher. The weekly money flow looking strong, daily money flow still negative, but starting to turn around here. But FedEx starting to make moves to the upside, broke above that 165 resistance level, which goes back to quite a bit here to the downside, and is really starting to potentially retest that 200-week moving average, which is just shy of the $200 level. So FedEx, a bit of a turnaround story here for the markets. So with that, that covers what I wanted to share with you guys here today. Like I said, a lot to cover here, a lot of questions about whether this is a market top, and I certainly think that there is a lot of caution that is necessary for this particular market. We certainly don't see the same type of momentum. I don't expect to see the same type of momentum unless the fiscal policy gets, we see some resolution on the fiscal policy side. Economics looking fairly strong. Markets are relatively healthy here. And earnings, big week of earnings coming up. I don't necessarily see this big week of earnings moving the markets heavily, but more likely where the risk to the downside here a bit for tech. So keep an eye out for all of those things. I will see you guys back here next Tuesday. Thank you so much. I hope you guys have a great trading day.